You're welcome to another lecture series on LAUTECH Open and Distance Learning Center. This is ACT 202 Financial Accounting 2, Study Session 6, that is Balance Sheet. After a business has been set up, there is need to know the financial position or the status of such business from time to time, such as how much profit or loss is being made, what are the assets and what are the liabilities, and so on and so forth, in order to have the necessary information to assess the company's financial position. Some necessary documentation is required, and this documented information is called the balance sheet. At the end of this study session, you should be able to explain balance sheets, explain and list the various components of balance sheets, as well as identify the components in the balance sheet. Meaning of balance sheet. A balance sheet or statement of financial position is a summary of the financial balances of a sole proprietorship, a business partnership, a corporation, or other form of business organization. The accounting balance sheet is one of the major financial statements that are used by accountants and business owners. Other major financial statements that are used by accountants are income statements, the statements of cash flows, and statements of stockholders' equity. The balance sheet is also referred to as the statement of financial position because the balance sheet gives the summary of what the company owns as well as what it owes to other parties at a particular point in time. In a situation where a company wants to request for financial assistance from a bank, the bank will go through the balance sheet of the company as at when the request is being made, because the balance sheet will give them valuable information on whether the company qualifies for financial assistance or not. And generally, people who are interested in balance sheet of a company are usually banks, current investors, potential investors, company management, government agencies, labor union, and so on and so forth. Components of a balance sheet. A balance sheet usually involve the assets, liabilities, and owner's equity. The whole of this usually make up what we refer to as balance sheet. Now let's look at this components one after the other. Meaning of assets. Assets are things that the company owns. An asset is anything tangible or intangible that is owned or controlled by a company through transaction and have future economic value that can be measured and expressed in monetary terms. Assets also include costs that are paid in advance that have not yet expired, such as prepaid advertising, prepaid insurance, prepaid legal fees, and prepaid rent. Now, the classes of assets. Assets are majorly classified into tangible assets and intangible assets. The tangible assets, these are physical assets, and it contains various subclasses, such as we have the current assets that include inventory. Inventories like cost of raw materials, intermediate and finished goods on hand for sale or for future use. You also have the fixed assets that include building, equipment, plants, furniture and fittings, etc. Now, the intangible assets, these are non-physical resources, and they are the rights that have a value to the firm, and because they give the firm some kind of advantage in the marketplace. Such intangible assets include goodwill, copyright, trademarks, patents, computer programs, softwares, and financial assets such as stocks, bonds, and accounts receivables. The balance sheet records the monetary value of the assets that are owned by the firm. Meaning of liabilities. Liabilities are obligations of the company. They are amounts that are owed to creditors for a past transaction, and they usually have the word payable in the account title. In simple words, liability is an obligation of the entity that which has a distinct existence as an individual unit often used for organization, that is the entity, and to transfer cash or other resources to another party. Now, classifications of liabilities. The liability is being classified in order of appearance on the balance sheet. We have the current liabilities and we have the long-term liabilities. Under the current liabilities, these are reasonably expected to be paid off or liquidated within a year, such as accounts payable, interest payable, wage payable, etc. While the long-term liabilities are reasonably expected not to be liquidated or paid off within the span of a single year, such as long-term bonds, notes payable, pension obligation, and so on and so forth. Meaning of owner's equity. Owner's equity is the words that are used on the balance sheet when the company is a sole proprietorship. If the company is a corporation, the words shareholders equity is being used instead of the owner's equity. Hence, owner's equity may be referred to as the residual of assets minus liabilities. It tells you the book value of a company, that is what is left over for shareholders after the company has paid off its all its debt. And as we have the equation here, the basic accounting equation of assets is equal to liabilities plus owner's equity. Now, if we rearrange that and make owner's equity the subject of formula, we have owner's equity to be equal to assets minus liabilities. Notes to financial statements. The note or footnote to the balance sheet and to other financial statements are considered to be part of the financial statements. The notes inform the readers about such things as significant accounting policies, commitments that are made by the company, and potential liabilities as well as potential losses. The notes contain information that is critical to properly understand and analyze a company's financial statements. It's been a wonderful time with you. I hope you had a wonderful time. Thank you.